we have a very exciting guest in the studio, but before we get to Trin and get her take in, we just wanted to highlight a story that has taken the imagination of investors on social media, and we did a bit of digging ourselves. So there are questions on Boat's financial reporting. Boat, of course, is the wearable tech company which is going to go in for an IPO end of December, and their statutory auditor has flagged serious concerns just before the IPO. They flagged issues in the recent filings of the DRHP. So this is all official. This is not some rumor. This is in their DRHP. And here are the concerns. They're pretty serious ones, Neeraj. I mean, if you go through them: systemic misrepresentation, failed accurate record keeping for 3 years, amongst other things.
It's quite something. It's quite something. So one is the first one that you pointed out, the systemic misrepresentation and the mismatch in financial statements, Tamanna. That's the second point, right? The discrepancy in financials filed with banks and lenders and the internal books of accounts. You don't normally see something like this. Yeah, there could be accounts done for taxation as well as representation purposes, but this is not that. This is a serious flag.
The third one is the utilization of funds so far. Questions have been raised regarding how certain funds were utilized. Short-term borrowings were diverted towards long-term projects. And then, of course, the question of what their numbers look like.
Yeah, and they go on to say that how company and the 5 associated entities have reported operational cash losses for that 2-year period, 3-year period from FY23 to 25. I mean, just before the IPO, you don't want companies with operational cash losses coming in at high multiples. So this is a serious flag again. Yeah,
that's another one. Compliance issues. I mean, the list goes on. I don't know how this license has actually happened. Lack of financial discipline and potential violations concerning director remuneration have come in. Directors' remuneration exceeded permissible limits under the Companies Act. That's another very big one.
2 subsidiaries may not be able to meet existing liabilities for FY23 and 24. Now, I mean, and then there is a set of other reasons. But Tamanna, this is more than anything else, the timing of this pointing out from a reputed authority, no less, makes me wonder what it means for the IPO, which is much spoken about.
The worst is, all of this is just documented in the IPO filing. There's no mention of what they're going to do about it.
Yeah.
Your key founders, a couple of them have left before the IPO comes in place, and there's non-executive directors who are taking charge. So, I mean, I would say, first of all, read the DRHP. Here's why you should. If you haven't, then we're here to tell you what to look for in it as well, on the other hand. And just beware when you go into an IPO on what really is happening with the company. All right. Special guest in our studio. Trin is a senior economist covering emerging Asia at Natixis now, joining in. Trin, so great to have you here in person.
Thank you for having me.
Yeah, we've spoken to you very often, you know, on Zoom, etc. But lovely to have you here.
It's a great pleasure to be in Mumbai. Thank you very much.
Yeah. I'm going to start with just talking to you about what you think is happening with the trade deal, because I quite enjoy reading all of your posts on the trade deal and, you know, breaking it down. And we just reported how the chief economic advisor says it should be finalized by March. In your view, why is this stuck when the relationship between the two nations, the two heads of state, is pretty decent?
Well, I think what the U.S. is trying to do is press India to change, and India changes in its own way, right? And I think in specific sectors, it has its own constraints, and that's why the trade deal is stuck. It is stuck because of, I think, geopolitically, you know, there were some difficult domestic considerations, like the local elections. But I do think moving ahead, there is some tailwinds to the trade deal. One is the Russian-Ukraine conflict is fading. Trump is facing 2026 midterm elections, and he's going to be much nicer on the affordability crisis. And finally, I do think that in terms of tariffs, it's not going to be as important going to next year. For India, the U.S.-India relations may be just a rounding error for growth. As you can see, growth continues to be quite robust. However, it's very important for sentiment. It's very important for income growth, and it's very important for the future of India in terms of attracting a lot of FDI. 2 things that people look at. One is obviously say if you invest in and look at the rupee, the trade deal is very, very important. May not necessarily be for GDP because it's a very domestic demand-driven economy, but that external shock, it's filtering through the income, and income is important. Even if consumption is boosted by GST rationalization, the sustainability of that will depend on the ability of India to broaden out the income growth.
Interesting. Trinh, what the evidence that we've seen in the last few days as well, I mean, day before yesterday, right? Microsoft, Intel, Amazon, all of them are putting in money. Google is building its largest infrastructure out of US in Hyderabad, right? So the FDI is not becoming as much of a problem as the foreign institutional investor flows or the FPI flows are becoming. Do you think they are waiting for the trade deal to happen, or would earnings growth in India bring back foreign portfolio investors?
Well, I think there are two ways to look at it. One is that Indian FDI tends to be concentrated in IT. So if you look at the big spurt before the decline recently, it's really huge spurts of IT into India IT, which has always been, I would say, an excellent sector for India. It's a source of trade surplus, it's a source of income. But what India needs to work on is also broadening that out, right? AI, again, is important, but is it a big job generation? It requires a lot of power, which is, I think, one of the bright spots as well for the past decade, is that India has invested a lot in power, energy and renewable, and so as a result, I would say yes, that's a positive, and it again highlights the strength, but we also need to broaden it out to other sectors. For foreign investors, obviously, when you look at these capex, they're actually investing in India for its indigenous domestic demand, right? And for that, we care about whether or not the average Indian rural or urban consumer is spending much more. Are they consuming in much more what products? Is the capex broadening out across the board? And it's really that middle income that's going to rise over time. But I do think that the momentum is there. That is a positive news, but we shouldn't also just disregard the other sectors. And one of the key points I often talk about when people don't talk about PLI anymore, when it was a bigger thing, most of the money has gone to bigger sectors. Sectors are already doing well. Sectors are already well protected. The auto, huge import tax already, and then as a result, it's well protected. Sectors that don't necessarily need as much help as, for example, labor-intensive sectors are currently being crushed by the 50% tariff. And even before the tariff, if you look at India trade data, it's been losing competitiveness to China, right? So people tend to think about China as a big tech player, but China produces a third of global labor-intensive manufacturing still, right? And the likes of Vietnam, Bangladesh, and so on and so forth. So I do think that that is important because that is really, it's going to target the weakness of India, which is a low formalization of jobs. I mean, the recent reforms, implementation of the labor code will help because it helps with some formalization by forcing companies to pay weak gig workers a bit more. But that's just taking from margins from one place to the other. We need to also grow the pie as well.
So let me take that forward. That was very well put. You're saying PLI is going into sectors which may not need it that much. The idea was also coming in from self-sufficiency, right? So then you had semiconductors and hardware and all of that incentivized. Where do you think that push needs to go now to protect jobs?
Well, if you look at, for example, even GST rationalization, there was an increase in taxes actually for items above $29 US, right? Those are actually the exact sectors you should help. Obviously, the average Indians will consume an item that's much lower, but when you export, you tend to export higher items. So I do think the sectors that need help are the ones that are going to employ a lot of people. What I mean to say is that it's great that India targets the self-sufficiency, and when it says self-sufficient, it's talking about higher end self-sufficiency in semiconductor and so on and so forth. But self-sufficiency can come in the lower end as well. If you look at the huge widening trade deficit with China, and also India has a trade deficit with every single country in Asia except the Philippines. And so when you look at that, then you can say, well, we can also increase self-sufficiency elsewhere. You know, things, basic household items, if you go across, you can see that huge imports from China. So I think that's a key point I would like to highlight, is that a country as big as India shouldn't focus on just the Silicon Valley of India, so on and so forth, but to broaden it across, right? Even the US needs to broaden that to really bring everyone up. And particularly here, when it's at the beginning of trying to move people from the the rural to the urban, that's going to be important. And I think one of the reasons why the trade deal is very stuck is the simple fact that the farmers feel and fear that if they give up what little they have to American soybeans or American corn, that is there an alternative for them? Other than the rural employment scheme, is there an alternative, higher paying factory job where they can go and get a consistent payment? And that is not necessarily there because the highlight is really these big data centers. And is that really labor intensive? Not necessarily. That's CapEx intensive. And that's, again, if you look at India exports, it's really an area of strength, right? Where is India exports really growing? ICT, not even targeted by tariffs. We forget that most of the exports are not targeted, and those are higher value items.
So, okay, Trin, I would love to know this. You have an opinion, you speak to people who might have flows or business interest into India. What is it that people are telling you? Are people waiting for the culmination of the trade deal for money to come in? And that's the question that I asked you first as well. Is there something that is keeping them back when it comes to India? Because the valuations have come off reasonably well, closer to long-term averages in India. And the earnings growth and the GDP growth looks pretty robust.
Nominal growth is important, right? So India has high GDP growth, but nominal like earnings is important. So if you look at sectors, you look at GST correction.
It's a good problem to have, Trin, that you have good growth and low inflation. So many countries would kill for that.
But if you think from a foreign perspective, right? If you ask me foreign, what happened to the euro today? It actually appreciated by double digits. What happened to the rupee? It's the worst performing. So what is the gap between the rupee to euro this year? If you're a euro investor, and you have invested in India, say nominal GDP growth in 8.2 was Q3, but nominal is close to 9, not even 9. But relative in euro, you're very down, right? And not to mention, not only do we have the depreciation of the euro, we also have the stock market doing pretty well relative as well. So it's not just the euro if you look at across Asia Pacific or even in dollar. So I do think that that's an issue, right? The euro is a shock absorber because the trade deal is kind of always imminently happening. I'm always having an op-ed ready to write about this deal when it happens, right? And everyone does, and sharpening their pencil. But the reality here is that we do have a lot of positive news. But on the external side, the rupee is quite important for foreign investors looking into India because when you take it all into consideration, the highest growth in the region, and if not the world. I was just in Paris marketing and talking about Brazil. Brazil real GDP is only 2%, but what's the SELIC doing? It's at 50%.
Yeah.
So on a carry trade perspective, I do think that this is where we're talking about. Growth in Asia is always more amazing than everywhere else because we have great fundamentals. Our reserves are great. We don't really have these issues as the LATAM countries have. But at the same time, it is a competitive environment and it is a dollar downtrend environment. The rupee is not strengthening against the dollar for obvious reasons. I think it's a good reason. It's a reason because inflation is low. It's a good reason because we need to also help these labor-intensive sectors that's losing market share, and that's an important for you think about longer-term perspective. And that's one of the reasons why the yuan hasn't appreciated as much as the euro as well, because everyone in Asia is trying to competitively devalue their currency to really just look, we're Asian, so this is but at the same time, this is one of the reasons why long-term, nominal GDP growth matters. Long-term, the trajectory of the rupee matters, and that's why I think the RBI has been very cautious in allowing depreciation, but not excessive volatility, because we can assume a 2 to 3% depreciation, but we go into 5% with slowing nominal GDP, and hopefully next year in our forecast is that inflation will rise and nominal GDP will rise, even if we have a forecast of decelerating real GDP growth. Then that's going to make a big difference, right? And I think that's what is on investors' mind as much as the strong fundamental story that India has structurally over a 5 to 10 year horizon.
Yeah. You spoke about the RBI and what signaling came from the Reserve Bank in the last policy as well. One would say that they have done what they needed to in terms of rate cuts, but do you think that there's more room and you will see more of that coming through?
The room depends on where you see the room, right? Room from a traditional perspective, as in real rates are very high. So which means it's tight, right? In terms of you take a nominal policy rate minus inflation, which is non-existent in the current trend, but obviously you can't just look at inflation now, but what you think inflation is going to be in the future, then there's room. However, as I mentioned, for the RBI, it doesn't want this depreciation expectation to be very anchored. And that is something that it also wants to signal that it wants the rupee to go, but not go too far. So I do think that there is one more rate cut for the RBI, but it's not in a hurry to do so. Let's not forget, everyone's talking about hikes now, next year.
Europe, Australia.
So the room for India is not just constrained within India, but if the Fed is cutting rates and we're not really certain where the Fed is going to cut, it just cut overnight. And I think the market is not even pricing in January.
No.
So for the RBI, I think it's going to delay until the end of Q1. Particularly if this trade deal is a moving target, right?
Yeah.
So it wants to move with the target as well, and it's going to feel much more comfortable when the Fed cuts quite a lot. The trade deal is more imminent. Moreover, there's strength in the economy on a nominal basis. Then I think we're seeing much more early Q2, if not end of Q1 rate cut for the RBI, rather than starting a back-to-back rate cut for India, because it's not just about what's happening in India, but it's also, as you mentioned, foreign investors look at India on a relative basis. You know, India is really big, but it's big in a big, big world.
That's well put. That's well put. Just, you know, one take on, and you mentioned the Fed, so a lot of moving parts. If I were to talk about moving parts, I think a lot of them in the United States right now. We don't know who the next Fed chair is. We don't know
Kevin, just kidding.
Kevin. Yeah, possibly. We don't officially know.
One of the Kevins.
The one who will cut rates faster, possibly. But we don't know if the push down on tariffs will continue or won't continue. How much do you think the world will try to decouple from what's happening in the United States, and can they? My context is like what India is doing, FTAs with individual countries, that let's at least secure ourselves.
Right, so India FTAs again is with its own characteristics. So if you look at the UK-India FTAs, it's opening up, but in the auto sector, right, it's opening up over a 10-year period for only high-end cars where it doesn't think the domestic players are going to be materially impacted. So I do think the trend for India is more trade, more liberalization. It will do so in its own way, and it will try to get there in its own way, but everyone's going to try to push India to change. And I think the synergies is going to get to a direction that's, I think it's very positive for India, maybe faster than India would like. The labor reforms is an example. So when it comes to the Fed, again, I do think that is going to be a very positive force for India next year. For example, big questions over fiscal dominance, right? If the Fed, if President Trump gets what he wants, he gets a very Fed-friendly chair, Lisa Cooks gets fired. So instead of 2 points, we're looking at 3 out of 7 plus the rotation. We're going to get a very friendly Fed that will cut, what if it cuts very aggressively? Not just cutting very aggressively, but very fast. But also, I think what's really important is this question of credibility.
Yes.
If investors have this credibility question, then they will want to diversify. And when they diversify, that risk premium that traditionally has been added to emerging markets, it's going to be less because on an equalized basis, we're going to have a little bit more risk premium to the US. But from an investor's perspective, it's not as easy, right? Because not everybody wants to appreciate against the dollar too much. A good example is a lot of the Asian traders that have a lot of surpluses that they recycle in US dollar, and that if their domestic FX appreciates too much, their unhedged portfolio is going to be down in the water, right? Even if it's not mark to market. The second thing is if you're a big trader, India is not, so when the rupee appreciates, everyone's really happy, except for those that really exports, because it's a bigger domestic demand market in imports. But for a lot of Asian traders, exports is much more important. You know, the VND is always going to be depreciating because that's much more important. The Taiwan dollar does not want excessive strength. So after that rapid appreciation, it's been depreciating. And I think that's the key theme here, is that the diversification trade will push Asian FX up, but the room for that to move depends on whether or not the Chinese yuan will move. You know, if we appreciate too much versus yuan, that can be a challenge as well. But fundamentally, I think it's going to be supportive of India going into next year because the risk pricing are quite high, right? We're pricing in trade deterioration and so on and so forth, and investors are very risk averse at the moment, and I think that risk premium can decline. And another thing I would say is that one thing that India has going for it that's often underappreciated is stable politics.
Yes.
Right? We're going to 2026 with a lot of elections in LATAM. We're going to 2026 with elections in Thailand imminently, and political instability in the Philippines and so on and so forth.
At least we're done with that bit. Most of the elections and state elections also done this year. Trinh, absolute pleasure having you in our studios and speaking with you.
Thank you for having us.